Welcome back to the Bitcoin Layer. I'm Nik Bhatia. Today we welcome back Matt Dines. Matt Dines is of Build Asset Management. He's an investor and somebody we look to on topics of credit, Bitcoin, global macro, and financial history. Matt, welcome back to the show.
Great to be here, Nik.
All right, let's start with what's going on in China. I want to get into your take on the convertible market and MicroStrategy. What is driving Bitcoin much, much higher? I know you have a great slide on the convertible market that we're going to get to, but I want to start with China. Is there an element to Bitcoin's rise that we can credit to China? Is there a currency crisis on the horizon in China? We're seeing a lot of depreciation, but it hasn't broken out above any alarming levels. So I wanted to get your take.
Yep. So the signal to watch right now in China is really its bond market, sovereign debt yields, and those have just been dropping like a rock. The Bloomberg time series for Chinese sovereign debt yields don't go back quite as far into ancient history as you may like, but these are record lows in Chinese sovereign debt. What that's signaling to me is the deflation inside of their own credit bubble internally in the Chinese yuan and the domestic economy is not something that's been slowed down over the last 2-3 years. But if you recall, Nik, the last time we were together, we saw the kind of the surge in central bank policy all the way to allowing for repo and central bank lending against not just debt securities but also equity as well. So there was that trend that's buoyed Chinese equity markets. Shanghai Composite is still hanging on to the gains that it's printed for 2024 year to date. That those haven't walked away. But the sovereign debt yields have continued to decline to the point where they're at record lows. When we say record lows, that's going back to all time of CCP sovereign debt issuance. So that's a big sign on the long term that something is going on here. Now you have to take that in context with everything else going on globally. The Trump election win and the Republican sweeps and Congress and the Senate are also, the driver there. And the rest of the world has been responding and reacting to that result on November 5th. China's been one of them. So you've seen the shift. I've got slide one. We'll talk about all the other events hitting G7 countries. But on December 9th, you saw Chinese economic policy leaders kind of come out with their consensus that they were going to shift policy towards, the quote unquote monetary loose.
And Dines, let me hop in here because we made a video about China after that announcement. So viewers should go check that out. Last week, we had an episode on China specifically covering this shift to loose policy. It is a signal, and in our judgment as well, it must be a response to the election and what they see coming. So before we get into the international Trump chaos, let's get into the collapse of yields themselves in China. It signals deflation, of course, as you're suggesting, because inflation is why you would sell fixed income. Deflation is why you would want to lock in any yield whatsoever. If prices are going down, you're going to get a shrinking of the economy, shrinking of debt. So that's the first order right now, what's going on in China. We can attribute the expectation of deflation to increased trade war, the continued reliance of China on the export economy, which means the U.S. consumer. And if the U.S. consumer is going to be facing these import tariffs on Chinese goods, that's all in the mix here for China's collapsing bond yields. My question to you then is, what are they going to do? We always hear the term bazooka associated with the Chinese government, their policy. We have a shift to moderately loose policy. We also have this idea that the Chinese sovereign bond market is getting going, and the People's Bank of China is going to be a buyer there. So my big thesis is an enormous creation of Chinese currency that will eventually drive a depreciation of that currency. But can you relate that thesis to the collapsing bond yields themselves and then give us your sophisticated take there?
Yeah, so the collapse in bond yields, as you mentioned, is really two drivers, both inflation expectations and then real growth. Now, on the real growth front, you've got two kind of wealthy export markets that have driven most of the consumption of Chinese material imports. And that'd be Europe, which is going through its own sickness, and then the United States. So part of that big kind of trend change that the Trump election and Republican sweep represented was, a complete, 180 policy difference between, what the Obama, Biden to Harris kind of chain of leadership would have represented. And then the continuation of the Trump train, which is, America first, mercantilist policies, which is, really the driver of, or really like a global trend that's ongoing. We can talk about other markets where you see this, but the combo of the tariffs and then the rest of the Trump package. So focusing on growth and reshoring inside of the U.S. Economy itself as kind of the walled garden, if you will. But then its immediate kind of friendly trading partners. That's really cut off what's been kind of the key to Chinese growth since the Deng Xiaoping era, right? Like in the post-Mao kind of boom that you've experienced in China. So when that U.S.-led growth becomes, more off the table, now you're looking at a Chinese economy where you've got to figure out something else, right? And so there's really no strength, no consumption demand in Europe to export into. We can get into the why, but what it amounts to is those are no growth economies, right? They're old, they're aging. That's just not where growth is. And when you lose your biggest client, or maybe not totally lose, but you're going to run into some major headwinds here, is what it looks like. You don't really have a path to transitioning the Chinese economy back into growth. So what you're seeing now is kind of a cascading flywheel where the entire post 2008 kind of landscape and Chinese economic policy has been, let's figure out the shift towards whatever's next. And the post Deng Xiaoping model is kind of fully baked, if you will. But what is that next thing for China is still kind of up in the air, right? It's been from the Xi Jinping thought, right? It's like we're going to lead in the industries of the future, semiconductors, AI, stuff like that. But that takes a lot of time to develop, and you also don't have any real proof points of like having success in that route. So right now, I would say the sovereign debt market, you could say it's a bond bull market, but it really hasn't been that strong. You're at all-time low yields on Chinese debt, but what it amounts to, I looked at this in the Bloomberg China aggregate, total bond composite. It's not actually that strong a result. It's like 4 or 5 single-digit % total return. And so there's not a real massive bull market. There's an okay equity market in China. But like to kickstart your economy out of this lull and rediscovering an economic engine, it's going to take time. And right now that's all kind of up in the air. So if you're a Chinese investor, I know you probably you're trying to get encouraged into bidding up risk or investing into risk or consuming more, and that's what things like the last set of policy or like announcements that we talked about, I think it was 1 or 2 episodes ago, where the central bank's going to start supporting equity securities. But as opposed to other markets like the U.S., where there is, in my opinion, a lot of growth potential, China is like it's in this episode of just having to figure it out. So there's a lot more risk there, and this all-time low yields, which Japan went through, Europe went through, the U.S. went through. Now China's there. It could be years later to decades later, right? Because Japan led the way on this trend. But their path out of this looks, I would say they have a lot fewer outs, like to make like the poker analogy. So, I mean, we could talk about the capital flight trends, those slides, potentially to put up. But if I'm a Chinese local investor, you're looking at that and like, all right, what am I going to do with my capital? And the answer I think you're starting to see is they want to get it out. And we can take it from there.
As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, and the main culprit, the main reason, is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush proof, and time proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. Yeah, I want the viewer to understand something here. There aren't a lot of people out there in the Bitcoin world with the full global macro approach to investing. And we're lucky to have Dines because first of all, I can say from personal, he's on his Bloomberg all the time. So he's doing his own personal searches and research from the primary source themselves. But then he also reads every article about every country. So when he says that China doesn't have a lot of outs and that it's unclear what they're going to do, you guys should be taking that seriously. I'm just being frank, because there's not a lot where I can just stump Dines and not have him come up with an answer, or at least his baseline expectation. He's not doing that on China because he's not well read on the topic. That's the point I'm trying to make here. He's not saying I don't see their way out because he just hasn't been reading enough on China. No, he's actually looking at Japan, Europe, and United States having multi-decade trends in lower yields and what that did, and trying to think out how China's going to play it out. So
here's where it gets a little bit concerning, and I don't think we're quite there yet. But if you look at the historical analogs for, you can call China a great power, right? At this point, the real risk, I think, for this next 5 to 10 years is for this kind of challenger power. Think of a good analog might be Germany, at the end of the industrial era, coming through World War I and into World War II, where the great powers kind of economic resources, their constraints, they run into that boundary wall, and they're just kind of at that dead end. What do you do, right? And your best answer is to start negotiating with the rest of the world, get involved in the global economy. But in these weird historical transitions where, credit systems are breaking down, we're at the kind of an inflection point of shifting, into a new era, right? World War I was the shift into the industrial age, right? Same thing now. We're going through something similar, in my opinion, with the information age, which comes with monetary upheaval, economic upheaval, international trade upheaval. The real answer would be to negotiate and kind of rebalance, and that would prevent, the conflict that naturally you want to push up against, right? But that's sometimes hard to do, and it may ultimately lead to, kinetic events or direct conflict. And I think that's the headline I'd be watching closely here is, as we shift through, we've kind of taken the Syria conflict into a new era here in the last 10 days. We can get into that on the broader picture in a little bit. Same thing, Ukraine looks like there wants to be some sort of, not final settlement, but like something intermediate. But the China situation is one that worries me. If you've been watching for the last, not just 10 years, but even just recently, 2024, the escalation with the Philippines and the South China Sea is getting to a point where you're starting to get concerned about the great power and where this thing, or a challenging power and where this could go. And what we're seeing in the first, month and change after the November 5th election results has really been the U.S. Closing off its domestic market as more and more countries are shifting towards this mercantilist trend, which I believe has legs. You do run the risk of making that exit ramp, a more and more difficult thing to accomplish. So I think, the deflationary bust or deflationary impact you're seeing in Chinese sovereign debt markets, it's going to take a shift towards, they call it a moderately loose policy. What does that mean? It has to mean more central bank purchases and funding of debt to try to kickstart the Chinese domestic economy. But, as we mentioned, those external markets are less and less available. The areas where China could export to, like Africa, South America, doesn't quite make sense with the Chinese framework, right? Your main advantage being low cost labor, and then exporting to continents where most of the economies are poorer than China itself. That route doesn't work. The domestic economy is aged out, right? Just because of the one-child policies of the Mao era. So you have no youth to drive domestic consumption. And the answer here is, or like the big question here is like, what do you do? And I think that's a big part. I think it's the number one concern for the world here. If you're looking at how this could go potentially sideways. The big problem, though, is everybody else has their hands full with their own situation. In most countries, it's their own growth or debt situation to deal with. So the risk is this big thing over here won't get tackled.
It's a little concerning to think about. Now, talk about the fact that the mercantilist trade, the protectionist trade, has legs. What are more implications from that? You can bring it back to the U.S. What should we be thinking about now?
Yep. So when we say the mercantilist trend, what it really means, and my understanding and perspective on this, is if you think about like the value chain on like an assembly line of goods, right? You start with the raw commodity, and I define a commodity as any good in my view, where competition has been just fully ramped up to 100%. Like there's no trade secrets, there's no barriers to entry, all of the above. It's things that humans are really good at producing. We've squeezed out all marginal costs essentially. So you start with like a raw commodity, cotton, cocoa, stuff like that. Things that humans are, pretty good at producing. And then you start making higher and higher valued goods, right? You assemble these things into, products at different intermediate stages. And then the value capture at each stage, works all the way up to, where you start with something like just raw silicon or metals, and then you work up to like an NVIDIA GPU. That's extremely high value add, takes a lot of knowledge, trade secrets, processes, capital to get to that finish point. What we're really seeing here is more and more countries are wanting to get out of being at those bottom rungs, and they want their domestic economies to do more and more of that value capture. And then, we may still conduct international trade together amongst nations, but most countries want it to be like as far up as they can get in that value chain. And so that has implications for the credit, balance, international balance of payments, financial accounts, all of that. And what we've seen is these massive imbalances, right, build up over the post-World War II era. So most of these domestic countries want to move that industry back into their economy as much as possible. Now, where does it come from? At its core, like the lowest of the low commodity countries feel like they're getting at this point kind of a raw deal in this economy. Like they're shipping out their resources at the low end of the spectrum. And that may include labor, right? And they're getting less and less of the value capture in this existing kind of credit framework. They get more and more in debt. The G7 themselves countries get more and more in debt. And this system is just like naturally working towards its ultimate progression. So when I say this has legs, you look at the headlines, right? You see, stories like Indonesia is no longer going to export its raw nickel, right? And then you see some of the big commodity, like international commodity traders like Trafigura, Vale, all those running into issues with controllership or fraud. You can look at like the JPM story of nickel shipments in a warehouse, which actually turned out once inspected to be full of like rocks and gravel. So the answer here, like Indonesia's example, where it's not going to export its raw nickel, a valuable commodity for several products like battery technology, et cetera. They're no longer going to ship that to the rest of the world markets. They want to move, the production and assembly of like higher value goods into their own economy, which, the belief is will be tied to more job creation, wage growth, et cetera. So rather than export at the low level or just live with low wages forever, you want to see more and more barriers put up domestically. Now, the question is, whether this works will depend on, how diversified and resource rich across your board your own nation state's economy is. And this is where, we talk about the growth being in the U.S. It's very hard to compete with the set of attributes and just resources that the U.S. possesses. Like we have our own credit problem, but we're in a much better position, I think, in my belief, from the resources perspective and potential growth than any other country to deal with. As well as we have, if you think about it as 50 states, 50 separate economies that can trade with each other, we have a very, I'd say, like robust economy like ahead of us. Not that there couldn't be potential issues or downturns, but we're much more readily prepared, I think, to deal with this new environment than other nations. So the Trump election really represented kind of the next wave, I think. After his first term, he started to put these policies in place. Biden didn't reverse any of them, right? Like there was no walk back. Like you could say there was a difference on immigration policy, on net new labor coming into the country, et cetera. But tariffs, et cetera, focus on reshoring industry. The Biden policy may not have like stepped on the gas and shifted up a gear, but there was no reversal in the trend. And then Trump 2.0 coming in, my opinion, what the market is preparing for, reading through the nominees especially, you're looking at the next stage of stepping up the gas. And I think what you're seeing here, we can go through, it's the first slide here, the immediate response we've seen post-election results those last 5 weeks is the rest of the world kind of reacting with that fork in the road that we just took between a continuation of a Harris path, which meant like not a reversal, but just kind of steady state, versus the Trump path, which is escalation in these trends.
Now, I want to ask you about the U.S. election. What are your thoughts on American exceptionalism, this term now being thrown around like never before. What is your view on the U.S. economy in this new Trump 2.0 era? Can you talk about AI, the build out of industrial policy, the nominees that you're reading about? How bullish are you on the U.S. economy specifically, or is some of it overdone on the hype in terms of how much we can really reshore and have better industrial policy than years past?
Yeah. Um, there's a lot in that question. This isn't, everybody looks at the cover indicators, right, of The Economist or Time Magazine, and you're seeing those, you've seen multiple iterations of that over the last 2 to 3 years on the resilience and of the American economy, the growth, et cetera. But I do think if you look back on all those attributes, like we've been in a bit of a lull, I'd say. Like there's definitely problems to recover from. Key among that is reshoring and industrial base. There's a lot of questions and uncertainties about what's it going to cost. Will it be inflationary? Will it add to the debt? All of these things. So it is a bit of a tightrope, but I think the rest of the world is walking the same path. And if you had to choose, if it's a draft between nation states, right, or maybe not even nation states, because there's going to be a lot of redrawns or lines redrawn in the coming years. I think we talk about like the Syria situation, et cetera. But if you're picking on the draft board, like your number one pick would be the United States, like by far. Like there's no competing. This isn't a tough decision. It's Peyton Manning's going number one. Ryan Leaf, okay, maybe that's China.
There's no Hakeem Olajuwon or Sam Bowie, let's just say.
Yeah, exactly. So I think in terms of like there is a real challenge here. To manage the debt situation, manage inflation, you need growth, and to take a recession would be very costly, which is part of the reason why it's so far played out that policy is making sure we don't steer into recession. But I think if you're looking at the nominees, I think the key one, honestly, is Besant, number one. Like he's someone who understands FX, understands capital markets. This isn't an academic, who only understands papers. He's also not a politician. Like this is a true macro fund manager who's been front and center at most of the key FX trades over the last 30 years. So if you're looking at just staffing, that alone, I think, was like just a reason to be bullish on the U.S. because, like, yeah, you do have a tight path to navigate through over the next 4 years. But if you're selecting, I think coming from a capital markets perspective and dollar-based capital, this is who you want. So that's the number one pick in my mind. You can sort descend after everything else that's going to go on. People can get excited about RFK Jr., et cetera. But the key one in my mind is Scott Besant.
Okay, so bottom line it for us in terms of outlook on U.S. growth, bullishness on industrial policy, reshoring. Is it overdone, or are we going to see something pretty dynamic over the next 2 years for the U.S. itself on maybe just legislated, like the first package, the first tax cut? What are we going to see?
Yeah. So I think the risk, if you press for more tax cuts, that's going to be risky because you don't know how the bond market is going to respond to that. You have the roll off of the Tax Cut and Jobs Act of 2018 coming. So we'll want to watch that to see, like, all right, what is the top agenda items that this Republican, control, across all three bodies, is going to push for. And there's a couple line items. You can push for more tax cuts. We've already seen, though, in 2018, we kind of know what you get from that, right? History repeating itself. You just do this again, you're going to get something similar to 2018, 2019. But then ultimately, the dollar cycle, the credit system, just that alone isn't going to be enough to shift the system or kind of the foundation onto the new trajectory here for the next 30, 40, 50 years, like in the broader kind of landscape, like over the course of a human lifetime, right? Half a human lifetime, which is how these long cycles tend to pay out. So if they just go for that, I think it's not as much upside as you want. And what you've seen from governments like the UK, especially in September 2022 with Liz Truss, we talk about the Liz Truss moment. There's big downside risk of doing that if the bond market doesn't like it, and you press deficits too far, et cetera. So that's a dangerous one to play with if I'm in the Trump cabinet and deciding on policy. But I think we can talk about this, the Bitcoin Strategic Reserve. If you're looking at like groundbreaking, generational type of just course shifting moves, right, to shift out of this post 2008 kind of like malaise that the U.S. has been better than most countries, navigating through, but it still is like we haven't shifted back onto the growth trajectory that we've been on prior. I think that the lowest hanging fruit would be for a policy agenda, getting the Bitcoin Strategic Reserve through. There's real momentum. It will be a battle, but you've got sponsorship in the Senate. You've got a lot of quote unquote crypto House members. Like I don't know how many are Bitcoiners, but the crypto, I guess, will come along. But you've got real Bitcoiners in the U.S. Senate. And then if it gets past those two hurdles, if it gets to Trump's desk, he will sign the Strategic Reserve Act. I view that as something that would be longer term course shifting. And if you're looking at these kind of eras of consolidated control, you in Washington, D.C., you only have 2 years to get something like massive done. So the first Trump term was the TCJA. You could say it worked, right? It helped. But if you just kind of go back to that same well, you risk not getting the same, result. But I think with the Bitcoin Strategic Reserve Act, that to me looks like not just the easy win, right? Because if you use all your political capital on solving something like healthcare, that's going to be really tough to do, right? You've had prior attempts at this, like Obama first term, wasted all of his post 2008 capital there, and didn't actually solve the underlying problems. Healthcare is risky. Going back to the tax cuts is risky. The Bitcoin Strategic Reserve, I feel like the political consensus is there, and it is like generationally breaking, high upside, low risk. So if you're looking at something to kickstart growth and the U.S. to lead the way, that one probably does it. It's going to be a fight to push through. But I think my opinion is we're probably under clocking the probability of that path.
And the price is not underclocking it. It's actually starting to price it in. I do believe that, just generally speaking, the price at about 107,000 as of this recording here on Tuesday.
It's starting to be marked to market.
Yeah, that's right. Tuesday, December 17th. So it's interesting that you actually say that the strategic Bitcoin reserve is a lower hanging fruit than the tax cut, and the tax cut is more dangerous for him politically because of, honestly, the stock market. Let's just be honest with it. If yields go up, it threatens the stock market. If the bond market has trouble, it's going to threaten the stock market. So you mentioned Bessent. Bessent is a markets guy. He's going to be having his Bloomberg terminal on every morning. So
no, he actually doesn't. He he mentioned this in an interview. He specifically does not log into his terminal because he doesn't find value in the green and yellow lights popping and flashing all the time. But he is like a religious studier of charts. He describes reading like 200 charts per evening. But he's an extremely focused individual, which is, I think, something you like to see in that position.
I love that. So he's looking at the charts. Let's just say his analyst sends them to him at night. And as he's going through his charts, he's looking at the dollar rising. how does he feel about that, Dines? We have a working thesis or an understanding that a rise in the dollar is potentially good, because why would they fight a rise in the dollar if the dollar is generally going to put a dampening effect on global inflation? If global inflation isn't going up too much, then Trump has more political capital than yesterday, as long as inflation is under control. Besson has talked about his three threes, one of them being 3% growth, one of them being the deficit to 3%. So how does he feel about the strong dollar, in your opinion? Do you agree with any of this? Strong dollar is good for lower inflation, which is good for Trump political capital.
Okay. So, following the 2008 and onwards trend of the US dollar, in my opinion, like the strong dollar is going to be important for this build out of the US industrial, or rebuild of the US industrial base, right? If you can't pull in resources, you can't finish that build out, right? It's tied as an input to finishing that process. Now, how long that process takes, this could be a multi-decade process, right? Like we're talking about building out chip foundries in the U.S. and it's like things we haven't done, or maybe we've done them, but they're at very small scale. U.S. hasn't been a major exporter in the post 1971 model. So there's things we have to do in terms of CapEx to get to that end game and pull off that transition to get to 3% real growth, which is there, I believe, and then reduce the deficits to 3%. I don't know when we get there again. It probably doesn't happen, in my opinion, on a timeline that Besant thinks, like a 2028 target, just because of the demographics, the cost in front of us for healthcare and Social Security. And then you also got to fund the defense problem as well for this kind of new environment, those things I talked about with China, et cetera. But you need the strong dollar to pull in capital to the U.S., but also resources to finish this build out process. So to get to the other side of this, I think we still need to see this this trend, if you look at it on slide 2, of the uptrend in the U.S. dollar. I think it's a necessary input. I don't know that you can have this or get to the other side on these objectives where policymakers and capital markets professionals want to take things, but you're getting signs here that it's getting tough to keep the dollar inside of this range. So what I mean by that, I divide this channel. This is just my heuristics here. This is what I track and how I've drawn the lines. Other people might view them differently. But there's kind of ranges here. There's an obvious and clear channel here on the DXY. But there's a point where the dollar gets too tight, or in the is it the three little bears? Analogy, there's
too
just
hot,
right,
too cold, and just right.
Yeah, so I call it too hot or too hard, too soft, and just right. Too hard is when we need, at some points you do different things, but too hard and the most recent episode was when we had to hike rates from 0 up to 5.5% on the front end to squeeze out that inflation. Too soft, we actually got like a scare there on the August data print. I think it was July's NFP number, where we got a scary jobs report. Everybody thought the U.S. economy, like the growth engine, was slowing down. That's when you got this big rally on the long end of the yield curve, but then also in the DXY, we bounced out of that. So that was kind of a false break. But too soft would mean like 2020 QE, right? Rates to 0, 6 trillion in QE and fiscal stimulus. But what we're trying to do is really manage the dollar, the natural inclination of like the global capital markets, FX, and the credit systems and all these currencies. Like the dollar wants to strengthen in the post 2008 environment, What I'll say to that is you kind of got 3 epochs of stability. And in this most recent one, you can kind of see it there in the boxes I highlight. It's getting harder for policy to keep it inside of that nice range where the system really functions well, like international capital markets function well. So you're having to see Fed speak or policy decisions shift over from like dovish to hawkish. It's more twitchy versus those prior 2 epochs, like in that 2018 to 2020 era where we had the TCGA. The system wanted the dollar to strengthen, and all you had to do as a policymaker was kind of throttle that strengthening, to slow it down a little bit, to keep it on that upper rail, like on the bumper. It's just riding that top bumper. Whereas the post kind of that European debt crisis we went through in the early phase of the 2010s, it wanted to hug the bottom line. The system wanted to take it too soft, right? Which means rates lower, QE, et cetera. It's like, okay, just kind of throttle how fast you're doing that QE or bond purchases. Or it could be the rates. Well, rates were fixed at 0, right? So you couldn't really do anything on that lever. But in this new era here, things that, like what this is telling me is the system is getting kind of more volatile. As a policymaker, you've got to flip your hawkish to dovish more quickly. And that's why we're seeing the central bank language. If you go back to like December 2023 and you listen to Powell speak, like you just sound, you feel like he's just throwing in the towel. We're going to have, a lot more rate cuts than actually materialize versus, things bounce to the other end. You feel you pick it up in the language. It's like, hey, this is getting more easy. So to navigate this system, from a monetary and fiscal perspective, it's getting a lot harder, which to me is, indicative of like a system that is like it wants to transition. We don't know which way, right? You can take your bets, but at this point, all it's telling us is for sure is that it's getting more volatile, and that transition wants to take place. And that's kind of downstream of all these things we're talking about here with China. And we didn't get into it on the headlines we're seeing, but across G7 countries after November 5th, the election results in the US, you've had finance ministers resign across Germany. France lost their prime minister, and this was entirely due to budget, right? And a reluctance from political peers and then the public to embrace the austerity measures that were proposed. You've seen it from Canada as well, as of Monday, where Chrystia Freeland resigned. So like you're seeing this thing, like the system is getting more and more unstable. But from the dollar perspective and from the US perspective, we didn't do it. Like we're the one who knocks, right? Like Trump won the election. There's no, tweets out there that are generating chaos. It's really like the rest of the world is in chaos responding to what we're doing. So it's a bit of a flip, in the post and the immediate aftermath of the 2016 election, where the internal media, the U.S., et cetera, we were all just losing our minds. The rest of the world was losing their minds, like Trump toilet tweets, et cetera. That's really been under control in my view this cycle. I don't see any crazy tweets firing off.
Barron told him to stop.
Barron told, there we go. Well, it's nice to have not handlers, right? But people you can listen to. But it's really the rest of the world kind of reacting to where the U.S. is going. So I think that goes along with the other trend too. We talked about the U.S. Resilience, robustness, the strength of the economy. And over the course of 8 years since 2016, U.S. has really pulled back. It used to be more reactionary, leading from behind, and now you're seeing the rest of the world respond to what the U.S. is doing. Now, will it prove to be right? Or when I say right, it's like it's outcomes based. We won't know this until the history is written. But at this point, the U.S. is now the driver again, in my perspective, as opposed to just the also ran.
Indeed. And it is a fantastic chart. We'll make sure to keep this chart up for several minutes on screen while people are listening to your explanation about this just right zone, what happened during the European debt crisis, which is that first rectangle, the second rectangle being this stability period, the first Trump tax cuts filtering through to the economy, the dollar appreciating, but policymakers just kind of trying to guide it on that rail as Dines described, and then this third rectangle as a more volatile period. But yes, Dines is expecting to bump up against the top end of this just right range, maybe even go beyond and see really how the world reacts. It's all path dependent at that point, for sure. Let's go to the next chart, the long bond. This is a bond chart that we've had on from you several times. This is that lowest coupon bond that got issued right after the pandemic. So a below 2% coupon there on a 30-year bond, trading at a $49 price currently, and breaking down out of that green channel, which is weakness, which means higher yields. Dines has the price here, so a lower price will mean higher yield. So just give us a quick technical outlook here on longer term treasury yields.
Yep. So where I saw the channel here before, we had a bit of a breakout, I would say, in 2024. It looked like a breakout as we got into that green ribbon. That channel you see in gray, that downtrend, that was like the first wave down. And we saw the sell off in long bond or long dated U.S. Treasury debt from really getting underway in 2022 and continuing through 2023. So you see the ribbon here, and coming out into, like, let's say Q2 of 2024, we were really watching for the reversal, like a bull market and long-term Treasury debt to come off or to rally. And we kind of did, right? There's definitely an uptrend, but in review now, as we're coming into the end of the year, it's been pretty weak, right? So you see technically a higher high into that July NFP print we got in August, but it barely crests. Like that's a weak higher high. And since the November elections, we've seen a breakdown out of that channel, a retest to try to re-enter, and then a failure over the last 2 weeks in December. So for the long bond, the way I'm viewing this, we shifted out of that higher, like negatively sloped channel that's in gray. But to me, the signal here on price for the highest duration Treasury bond that exists right now, it's still in a downtrend, right? And so these kind of technical weakness, I would say, is something to watch here. I know on the bottom I have volume, and you have seen this. I use TLT volume because volume in the cash bond market is going to be opaque. Like a lot of it is.
You can't look at bond volume on an individual treasury issue. And
it's not FINRA
signal.
trace reported like it would be on a corporate issue or similar. So I put TLT there. You've seen more TLT volume pick up, but there's also more bonds. Like there's more TLT, like there's more underlying treasuries that need to be bought. Now, not as much as the creation, like the new treasury creation on the front end of the curve, but this pickup in volume on the ETF, which is market observable, and it did pick up starting in Q4 of 2023. It's really not like the trend isn't really following price, which is something you'd want to see if you really thought that a reversal or it was time to press buy on longer dated Treasury debt. So to me, it's weighing risk reward. To me, it still looks like the long end is a fade if you're a fixed income manager like myself. And until you see otherwise, until you see more strength out of this chart, I think that perspective we've been in on a secular transition, starting in the late 2010s, but really getting underway in the post-COVID environment, that trend still looks to be alive and running.
They definitely have to get this deficit answer for the public, for the investing public, the Doge question, the military build out that you mentioned, the tax cuts, a lot of questions on the 30-year side of things in the bond market. So of course, it will be path dependent as well there. I want to just look at slide 4 real quick, and I'll cover it here, Dines, that 2016 was convincing domestic capital to stay in the United States. 2024, Trump has the SoftBank CEO on stage pledging $100 billion while he tries to shake him down live in front of the press for another $100 billion. This is that USA leading now narrative that you're getting into, and I'll let you respond to it in a second. But let's just move to the next slide as well, in which we cover the completion of the first Arizona-based Taiwan semiconductor chip foundry. It had a lot of delays. We covered some of those with Kelly Lannon in an episode earlier this year, the struggles to get that factory finished. Now it appears that the factory is sending wafers out to various customers to try to test quality there, and that will be live in 2025. So talk about the reshoring narrative from the bond market, and then we'll close on MicroStrategy bonds because we haven't forgot about that.
Yep. So on to the reshoring theme, right? Getting capital invest. I think the poster child for this, like the number one project you would look to, would be the TSMC Arizona, foundries that are being built out. When these bonds were issued, this was like April 2022, to fund this project. You had a lot of question marks, and these things came with what was actually a pretty sizable discount. So these guys, just for benchmarking these were AA minus corporates, which is like, there are not that many AA minus or double A's out there. There's 2 to 3 triple A's, some double A's, a lot of A's, but like these, there's not too many like corporate entities like with the balance sheet strength and income statements to earn that AA. They had to come with a huge concession, right? 160 bips at the front end of really the bond market sell-off. So these things it wasn't quite like high yield OAS or like spreads, but probably something more like a triple B or triple B plus, like for this era. So the market, like US dollar capital markets, were not really a believer in this entire, reshoring narrative playing out. But you see, like, as the treasury curve, this is the relative value screen on Bloomberg. So the top chart is going to show 2 yields. The bottom one is the benchmark security, and the white, that's your treasury yield that this bond is indexed to. And this is a 2052 maturity. So it's going to be tied to the on-the-run 30-year treasury yield. And then the top line in orange and then the green spread is the yield difference between the yield that these bonds are traded at. And so what you've seen over, the 2 years almost, 2 years and change, that these bonds have been outstanding is just 130 bips of spread compression. And so these bonds, like, they've been at roughly the same yield, but the treasuries have walked up to them in terms of risk, as opposed to something different like a spread blowout or something like that you would have seen if the bond market wasn't a believer in this project. And so what that tells me is really like the credibility is being earned in the credit capital markets for these type of projects. Now, how many more TSMCs do you get? Like, building a chip foundry is just a massive capital undertaking. I don't know how many you need, but it's really a proof point that the U.S. economy domestically is, by the looks of it, on path to be successful at this reshoring trend. So in terms of checking off one of those question marks from the policymakers' perspectives, like, can we do this? What are the inputs that need to take place, et cetera? And you mentioned there were complications here, both resources, construction, and then culture as well. Like, there were a lot of issues between, management culture in Taiwan, and then the on the ground stakeholders, the management in Arizona. But the market is really giving you a signal here on price that that process is by all indications heading towards a successful outcome. So that's one indicator I follow. I remember that deal when it came to market in April. It's something I've been following closely. It's kind of one of those unique bonds in the U.S. corporate market.
And we'll also make sure to remember your point about the strong U.S. dollar contributing to the import of necessary materials for the build out, including labor, but for the build out of this new American industrial age, or this mercantilist age that we've entered in. Let's finish with your last slide here. If Bitcoin related activity was its own sector in the US dollar convertible bond market, it would rank second amongst all sectors by market value in 2024.
For the 2024 production. So this is the new, and that's kind of a forecast of industry trends. Like, what do you see in the next few years, the future, right? Which corporates are going to be able to tap this? It's really like the frontier capital for corporate debt. There's high yield, there's levered loans, there's unrated corporates, but convertibles, like, it's amongst those like riskier frontier. Like, you wouldn't see these companies cracking the investment grade corporate debt market. But what you're seeing here, like in terms of just nominal value here, this is a slide I showed at Bitcoin Mina on stage. Between the, call them Bitcoin related just financing activity, right? You got MicroStrategy leading the way. You had Coinbase come to market with an issue earlier this year, towards the end of Q1, early Q2. And then you've seen Bitcoin miners kind of pile onto this trend as well to capitalize themselves, add Bitcoin to the balance sheet, rinse, repeat. That strategy is working for the corporates. You've seen these Bitcoin related bonds be some of the strongest performers. The other group here, this is interesting for the kind of the military build out, or part of the reshoring and rebuild of U.S. industrial capacity to rebuild, your aerospace and defense industry, drones, as we're seeing in the headlines this week. The Bitcoin related activities would be like your top performing convertible issues for 2024. And if you look at them as a group, this segment is becoming a more and more important market for this niche sleeve, I would call it, in US dollar credit. So yeah, if you put those entities together, led by MicroStrategy clearly leading the way, has the strongest balance sheet, among these individual firms, it's number two, right? And part of that is it's about 6% of issuance for share of 2024 production in this space. But because the price appreciation is just part of that flywheel, they've been the number two performer. So allocators into this space, as the convertible bond market does well in terms of posting total returns, that's going to attract more capital and more credit creation to firms like this. And then that trend within the sleeve of convertible corporate debt is also going to become a more and more important borrowing client base. So you're going to see these firms start to reach out and seek, in my opinion, deploying into the Bitcoin related market opportunity. And that's just going to be a flywheel here, above. And that is ultimately, in my opinion, you're talking about trends. Obviously, I'm on the Bitcoin layer. Our thesis is Bitcoin is a real trend. That we can zoom out on this whole picture. Besides the nation state process, like, Bitcoin is the straw that's stirring the drink. Like, would Trump have gotten elected had he not reached out to and appealed to the Bitcoin, you say the crypto client base as well, but at the end of the day, we all know it's Bitcoin driving that trend. Like, Bitcoin's the real trend. But Bitcoin is going to be, in my opinion, a more and more important part of the broader, global trends at the nation state level that we've talked about, starting at the beginning of this podcast and working our way down and ultimately finishing with Bitcoin at the bottom of the funnel.
We have entered the Bitcoin age. Please definitely go check out my new book coming in February 2025, Bitcoin Age. It is something that I've been working on for almost 2 years. I'm really excited to share that with people. We are entering an era in which Bitcoin is stirring the drink itself, as Matt Dines so eloquently put. Matt Dines, thank you for joining us once again. Please tell people where they can find you online.
Yep, you can follow me on X at LeveredUSTs. And Nick, I'm really excited to read that new book. Can't wait for it.
Fantastic. We'll catch you guys next time.